In part 1, you learned the quick checklist for spotting undervalued REITs. But here's the truth. Cheap doesn't always mean good. In fact, buying the wrong cheap REIT can trap your capital for years. In this video, I'll show you the advanced traps to avoid, and the hidden signals that reveal the real winners, the kind the pros scoop up quietly before the crowd catches on. Quick refresher, you're looking for a price to FFO under 12x, a dividend yield that's 1-2% above the sector average, and a NAV discount of at least 10%. But now, we're leveling up, because numbers alone don't protect you from landmines. Trap 1. Value Trap REIT. Some REITs look cheap because they're shrinking. Their cash flow FFO is falling, they've cut dividends, or their occupancy rates are slipping. This is a classic value trap. In other words, it's not undervalued, it's just less valuable. You might see a shiny 10% yield, but if it's because tenants are leaving and revenue is drying up, that yield could vanish overnight. So how do we tell a shrinking REIT from a hidden gem? We start with growth. Advanced Signal 1. FFO Growth Trend. A truly strong REIT can be undervalued and growing. The key? Look for stable or positive FFO growth over a 3-5 year period. Even flat FFO can be fine if debt is low and the market is punishing the stock unfairly. But a steady upward trend? That's gold. Bonus, compare FFO growth to sector averages. If it's beating peers, you've likely found a mispriced winner. And you don't need expensive software to check this, but even great growth can be wiped out if the REIT is drowning in debt. Trap 2. High leverage REIT. Leverage isn't bad by itself. REITs use debt to grow. But too much debt can kill a REIT when interest rates rise or refinancing comes due. As a rule of thumb, keep debt to EBITDA under 6x, and always check the debt maturity schedule. A REIT with a wall of repayments due next year is far riskier than one spread over a decade. Advanced Signal 2. Interest Coverage Ratio. This ratio shows how easily a REIT can pay its interest expenses. Over 3x is strong, between 2x and 3x is okay but worth watching. Under 2x, that's a red flag. One bad quarter and the REIT could be forced to cut dividends or sell assets, but even healthy REITs can be dragged down by forces beyond their control. Trap 3. Sector Headwinds. In 2023, office REITs looked dirt cheap and stayed cheap. Why? Sector headwinds, rising vacancies, remote work, and tenant downsizing created a long-term drag. If an entire sector is under pressure, you need a very strong reason to invest. Otherwise, you're betting against the tide. But there's a way to spot when insiders see the storm clearing. Advanced Signal 3. Insider Buying. When executives use their own money to buy shares, it often means they see value the market is missing. This is especially powerful after a long downtrend. Check Form 4 filings or sites like Open Insider. Multiple insider buys within weeks can be a bullish tell. Bonus tip, AFO payout ratio. This shows what percentage of cash flow goes to dividends. Under 80% is healthy and gives room for growth. If it's over 100%, the REIT is paying more than it earns. A cut is just a matter of time. This single metric has saved me from multiple dividend disasters. Now, let's put all the pieces together. The sweet spot is where valuation, growth, and financial health intersect. Combine the Part 1 checklist with today's advanced checks, and you'll avoid traps and find high-quality bargains that can compound wealth over years. Recap. Your advanced checklist: FFO growth, healthy leverage, strong interest coverage, favorable sector trends, insider buying, and a sustainable payout ratio. Apply these, and you'll think like a REIT pro. Subscribe and turn on notifications. See you in the next one.